Pankaj Tibrewal joins us now, Senior Fund Manager with Kotak Mutual Fund. Pankaj, good to have you back. Thank you for joining us. I'm going to take today's volatility aside, but if I still measure the market action from the July low or from the June low, it's been almost like a joyride. It's been one way, and it's been a recovery of more than 15% plus. Somewhere, are you surprised with the market recovery?
Good morning, Nikunj. Somewhere in June end, we were forming the view that there would be a change in narrative in the next 4 to 5 months, and the change in narrative would be peaking of inflation and peaking of interest rates. To our surprise, it just happened in 20 days' time. And from mid of July, we saw that markets have started reflecting that second half of this financial year, probably inflation trajectory will be far lower, and hence interest rates will follow downwards. I think market has taken that in stride, and that has taken us a little by surprise. And also the FI selling had a role to play. I think in the last 8-9 months, we saw more than $30 billion of FI selling. From mid of July, once the global market started participating and rallying, we saw that intensity coming down, and in August, they have turned actually buyers. So I think combination of both have led to the rally, what we have seen. But as we speak today, I think markets are clearly at the upper end of the valuation range. And we believe that in the near term, there's very little upside. And one needs to be clearly having a stock specific approach to this market.
We were at same levels last time, let's say in beginning of the year. The market setup was different. A lot of IPOs. There was a bit of a euphoria in terms of what was happening in the fintech space. IT was in a booming patch, so to speak. Now the scenario is different. IPOs have dried up. Fintech companies, promoters are admitting that they need to be profitable, and there is a 20% decline in IT. How would you look at that end of the market?
So I think clearly the froth has been taken out, and I think people and markets are realizing that staying in a private space is a different ballgame, and the innings which you play in a public market is very, very different. So I think all these new age companies are also learning, and clearly I think the correction we have seen in the IT sector is not on a standalone basis. We saw in the first quarter there was pressure on margins, and what we are picking up from global cues that if global growth is in question, at some point of time, it will reflect on the demand for the IT services in the country today. And I think from a second to or third quarter onwards, our belief is that management commentary of most IT companies would start warning or cautioning us that the demand environment has started to slow down. And I think from whatever cues we are picking from US companies, some of them are hinting towards cut in IT spends. And I think with a lag, it will reflect in the commentary of most of the IT companies as you move into the second quarter and third quarter. So our stance currently is stay underweight. Probably one more round of derating is still there in the mid-cap IT space. The valuations are still not comfortable. They are still above average. And probably after maybe 1 or 2 quarters, you will get an opportunity to relook at the sector again.
Okay, so that's your strategy when it comes to IT. Clearly, everybody's waiting for that commentary on whether spends are being reduced. The companies have started acting on it with the likes of reports coming in of TCS and Wipro delaying variable payouts. So in this, against this setup, Pankaj, then will banks be the big winners? We saw what happened in the earnings season that's gone by. It's not just the record low NPS, but the credit outlook that we're getting from banks. SBI talking about a 14% credit growth type of outlook. Can that be the strategy coupled with the FII's comeback?
Yes, that's been one sector where we have been positive, especially the private sector banks. We believe that there's been a time correction on valuation side. Earnings growth is picking up. Provisions are at all-time low. And barring this quarter where a part of PPOP was impacted because of MTM losses, but credit growth bodes well for the entire sector as a whole. And also, don't forget that in the early part of rising interest rates, NIMs are impacted favorably for banks. And we believe that for the next 6 to 12 months, bank could be in a good position. Uh, in the first quarter, FY23 earnings season gone by, bank reported very strong earnings growth, and a large part of earnings growth in Nifty was driven by banks. So I think this year could be a very strong year for banking sector. And with FI selling also slowing down, I think this sector could see an upward trajectory.
But then if one wants to take advantage of this trajectory, Pankaj Tibrewal, what should one be looking at? SBI, which gave phenomenal returns in 2020-21, HDFC Group, which is still playing catch up, ICICI has been a star. I know you won't talk stock specifics, so let me try and rephrase. Private sector lenders versus public sector lenders. There are also big opportunities that one sees with the catch up of the mid-tier banks.
So we stay put to the large private sector banks and couple of names on the PSU side. And I think that's the way we believe our portfolios are positioned. And I think from a medium-term perspective, market share gains are moving from PSU to private. At best, the PSU banks, X of the leader, could be trading bets, not structural bets. We are still finding it difficult on the tier 2 and tier 3 names in the financials. I think in NBFCs, the entire space is now being dominated by 3 or 4 names. Most of them are in large caps again. In the mid-tier banks, clearly there's a challenge on market share. There's a clear challenge on growth. So very limited choice in the tier 2 and tier 3 names. But the preference lies for large private sector banks and selected PSU names. And also don't forget one theme which we are, apart from financials, which we are positive on. And Nikunj, Aisha, I think this is a structural theme where we are seeing a 3 to 5 year opportunity, is the manufacturing sector. After a long time, when we are interacting with companies and leaders of the space, they are so optimistic about the growth story. And it's not only the domestic growth, the export part, which is playing a big role. We all heard about China Plus, how it is impacting and benefiting us. But the next big driver, which has been there in the last 6 months because of energy crisis in Europe, is the Euro Plus strategy. When we speak to industrial manufacturing companies, when we are speaking to auto and companies, which require skilled manpower, and don't forget, India is a hub of engineers. India is a hub for manufacturing, shop floor engineers. And that, I think, is a big trend which is in making. And many sectors are definitely getting impacted positively. We recently were speaking to a few auto and companies. They said that we used to go to the OEMs. It used to take at least 18 to 24 months for product approvals. Now they are coming to us and asking us, these are 100 samples. How many of you can you manufacture and give us in the next 3 to 6 months? I think the order has reversed. And I think if we play our cards well, the next 4-5 years on manufacturing could be very positive for the country as a whole. And if we could sign 4 or 5 FTAs, which is the free trade agreements in the next couple of years, I think India can become the manufacturing hub for Asia, apart from China.
That's a very interesting point that you made, Pankaj, on manufacturing. Wanted to understand, where else are you seeing such opportunities? I believe home improvement is another segment that you like, and we were just chatting with Keshav Bhajanka from Century Ply as well. Wanted to understand where within this pool are you finding newer opportunities that one can still buy?
So our preference lies in the entire real estate cycle towards home improvement. We believe the cycle has just started. It's been 1.5 years. We believe that there's at least 3 to 5 years more into the cycle on the residential real estate upcycle. And the way we are playing is that not through developers, very selective on developers, but more through the entire home improvement sector. Don't forget, when the elephant starts walking, it impacts the 200 industries around it. Whether it be cement, whether it be tiles, whether it be plywood, whether it be mattress, consumer durables, wires and cables. So that's a very large sector. And the good part about it is that you have leaders in every space. So whether you talk about tiles, plywood, mattress, consumer durable, consumer appliances, cement, they're all good quality companies with decent ROE, decent balance sheet and cash flows, and leader in their own space. So I think this is one space where we think that it could be a structural 3-5 year opportunity. In between, obviously, you will get blips sometimes on demand or on margin, but structurally speaking, these are B2C businesses looking very good from a 3 to 5 year perspective. Most of them could be played from mid and small cap side, and most of our portfolios are positioned accordingly.
To have you on the show as always and discuss stock ideas as well. I'm sure our viewers are going to benefit a lot from that.